Unit 10. Trial balance, rectification of errors, and adjusting and closing entries. Trial balance. A trial balance is a list of accounts and their current balances at a given date. It is usually prepared on the last day of the accounting period, and the list of account balances are arranged according to debit and credit balances. Before preparing financial statements at the end of a period, the books must be balanced. That is, to determine total debits equal total credits. This is determined by preparing a trial balance. Debit balances are listed in one column and credit balances are listed in another. The two-column totals should be equal. When this occurs, the ledger is said to be in balance. Preparing a trial balance for a company serves to detect any mathematical errors that have occurred in the double entry accounting system, provided the total debts equal the total credits. The trial balance is considered to be balanced, and there should be no mathematical errors in the ledgers. A trial balance is prepared for two reasons. 1. To check the arithmetic accuracy. That is, the debit totals and the credit totals should be equal if the double entry system of bookkeeping is followed. 2. To write up the financial statements, that is, trading and profit and loss accounts and balance sheet. Types of errors. Keeping in view the nature of errors, all the errors can be classified into following four categories. 1. Errors of commission. There are the errors which are committed due to wrong posting of transactions, wrong totaling or wrong balancing of the accounts, wrong casting of the subsidiary books, or wrong recording of amount in the books of original entry, etc. For example, Rajhans Traders paid rupees 25,000 to Preetpal Traders, bracket open, a supplier of goods, bracket closed. This transaction was correctly recorded in the cash book. But while posting to the ledger, Preetpal's account was debited with rupees 2,500 only. 2. Errors of omission. The errors of omission may be committed at the time of recording the transactions in the books of original entry or while posting to the ledger. These can be of two types. First, error of complete omission. Second, error of partial omission. When a transaction is completely omitted from recording in the books of original record, it is an error of complete omission. For example, credit sales to Mohan rupees 10,000 not entered in the sales book. When the recording of transaction is partly omitted from the books, it is an error of partial omission. If in the above example, credit sales had been duly recorded in the sales book, but the posting from sales book to Mohan's account has not been made, it would be an error of partial omission. 3. Errors of principle. Accounting entries are recorded as per the generally accepted accounting principles. If any of these principles are violated or ignored, errors resulting from such violation are known as errors of principle. For example, Amount spent on additions to the buildings should be treated as capital expenditure and must be debited to the asset account. Instead, if this amount is debited to maintenance and repairs account, it has been treated as a revenue expense. 4. Compensating errors. When two or more errors are committed in such a way that the net effect of these errors on the debits and credits of accounts is nil, such errors are called compensating errors. For example, if purchases book has been overcast by rupees 10,000, resulting in excess debit of rupees 10,000 in purchases account, and sales return book is undercast by rupees 10,000, resulting in short debit to sales returns account, is a case of two errors compensating each other's effect. Rectification of errors. Errors can be classified into two categories for the purpose of rectification of errors. Rectification of errors which do not affect the trial balance. The following errors do not affect the equality of the trial balance totals. Errors of omission. A transaction is omitted completely from the books so that there is no debit and credit entry of the transaction. For example, drawing of rupees 5,000 cash by the proprietor was not recorded. Errors of commission. An entry is posted to the correct side of the ledger but to the wrong account. That is, items have been posted to the wrong account of the same class. For example, payment of rupees 1,000 cash by a customer A, John, was wrongly posted to the account of another customer B, Johan. Errors of principal. An entry is made in the wrong class of account. That is, when an expense is treated as an asset and vice versa. For example, repairs to building rupees 4,000 was debited to the building account. Complete reversal of entries. An account that should be debited is credited and vice versa. For example, a check rupees 2,000 received from Sunita was debited to the account of Sunita and credited to the bank account. Compensating errors. Errors on one side of the ledger are compensated by an errors or error. For example, the purchases account and sales account were both overcast by rupees 1,500. Errors of original entry. The original figure may be incorrectly entered, although the correct double entry principle has been observed using this incorrect figure. For example, credit sales of rupees 9,650 to Ranjit was recorded in the sales account and Ranjit's account as rupees 6,950. Rectification of errors which affect the trial balance. Errors which are revealed by the trial balance are those errors which cause the trial balance totals to be in disagreement. Errors in calculation. If there is any miscalculation of the trial balance totals or the net account balances, the trial balance will not balance. For example, there was an error in the calculation of the cash balance, causing the trial balance totals not to balance too. Errors in omission of one entry. Omission of either the debit or credit entry of a transaction will cause the totals of the trial balance not to agree. For example, a check rupees 5,000 received for commission was debited to the bank account only. Posting to the wrong side of an account. Entry into the wrong side of an account will cause one side of the ledger to be more than the other. For example, a check of rupees 8,000 paid to creditor K. Raj was credited instead of debited to his account. Errors in amount. If the debit entry of a transaction differs in amount with the credit entry, the trial balance will not balance. For example, cash rupees 9,650 received from Anand was debited to the cash account as rupees 9,650 and credited to the account of Anand as rupees 6,950. Summary. 1. An account has a debit balance when its debit total exceeds its credit total. 2. An account has a credit balance when its credit total exceeds its debit total. 3. Asset, expenses and drawings accounts have debit balances. 4. Liability, capital and revenue accounts have credit balances. 5. A trial balance is a list of debit and credit balances extracted from the accounts in the ledger at a particular date. 6. The trial balance is prepared for the purpose of checking the arithmetical accuracy of the entries made in the ledger. 7. The total debit balances will equal the total credit balances in the trial balance if the double entry principles of recording have been strictly adhered to. 8. Errors that affect the agreement of the trial balance totals are wrong calculation of balances, omission of either a debit or credit entry of a transaction, entry on the wrong side of an account, and errors in amount. 9. Errors that do not affect the agreement of the trial balance totals are complete omission of entries of a transaction, errors of commission, errors in principle, compensating errors, and errors in original entry. 10. Asset and liability accounts are balanced and their balances brought down to the next accounting period. 11. Personal accounts record transactions with persons who have dealings with the business. For example, debtors and creditors accounts. Adjusting entries. Some common adjustments are 1. Closing stock. 2. Expenses due but not paid. Bracket open. Outstanding expenses. Bracket closed. 3. Expenses paid in advance. Bracket open. Prepaid expenses. Bracket close. 4. Incomes due but not received. Bracket open. Accrued incomes. Bracket close. 5. Incomes not due but received. Bracket open. Unearned incomes. Bracket close. 6. Depreciation on assets. 7. Interest on capital. 8. Interest on drawings. 9. Interest on loan. 10. Bad debts to be written off. 11. Provision for bad debts. 12. Provision for discount on debtors. 13. Provision for discount on creditors. 14. Losses on account of accidents. 15. Commission payable on profit. 16. Goods used by the proprietor. 17. Goods distributed as free samples. Closing entries. Closing consolidated journal entries are normally passed for 1. Transfer of all manufacturing and purchase expense to the debit side of trading account. Transfer of purchases and sales returned to the debit side of trading account. 3. Transfer of sales and purchases returned to the credit side of trading account. 4. Transfer of closing stock to the credit of trading account by an adjustment entry. 5. Transfer of gross profit to the credit side of profit and loss account. 6. Transfer of gross loss to the debit side of profit and loss account. 7. Transfer of all administrative, selling and financial expenses to the debit of P&L account. 8. Transfer of all operational and non-operational incomes to the credit of P&L account. 9. Transfer of net profit to the credit of capital account. 10. Transfer of net loss to the debit of capital account.